You guessed it, the big number. Today we are looking at 7,000. That is unfortunately how many employees Disney announced they're cutting between now and the start of summer, as the first round of these layoffs begin this week, according to an internal memo sent by head honcho Bob Iger. The cuts are part of a broader strategy for the company to reduce corporate spending by $5.5 billion. So, Garrett, we have another big round of layoffs as they have not slowed down yet. Are you seeing any issues coming to the job market with so many people out of work?
I mean, there's going to continue to be some weakness in the U.S. economy. Good morning, everybody. Moving forward, we have the highest terminal rate for the Fed funds rate since 2007, and we're still hiking despite the banking failures. So the cost of capital continues to rise. They're raising the cost of capital on the private sector. That's obviously going to impact business and spending and expectations moving forward. And as far as Disney goes, I live in Florida, Vaz, and that means that I get a discount in April. So we're going to be going back, and I'll report from effectively Disney World in 3 weeks and let you know.
You're going back?
Yeah, we're going back.
In a year.
Yes, we have. Well, look, you get 2 days for like $150. Got to doing it. Garrett, we're doing it.
Save me a spot on the teacup ride. But besides that, listen, a lot of these companies stacked up on employees during the pandemic. So was this a predictable move? I mean, it was first tech. Now we're seeping into Disney.
Look, this is going to continue for a while. This is not going to slow down in any way. And even if the Fed starts to cut interest rates, you're still going to see layoffs coming. We are a services economy, and it's obviously was going to spill over tech. What we had spoken about before, which is really critical to understand how this works. The cuts typically start in the venture capital world. Why? That's the startup space. And it obviously spilled over in a lot of places across Silicon Valley and the big technology companies. Then it starts to move over and toward the services economy. Ultimately, where this ends up, and I really haven't seen it yet, is in the big entrenched companies. Think the big IBMs of the world. Think of the companies like the Marriotts of the world, the companies with tens of thousands of employees. It takes a while for these companies to actually do this because they hire consultants who go through to try to streamline all of the operations. That's why we pay attention to the consulting companies like Huron and McKinsey and anybody else who would be doing organizational restructuring in this type of environment. Those layoffs are probably going to come, but not until the third quarter of this year.
Garrett, Disney cheered the news. We did see the stock pop up. Do you think this is a longer term play, or is this just knee jerk reaction?
There's a lot here within Disney, which is really, really difficult because the company's still trading at an outrageous price to earnings ratio. I think it's up in the 50s. And as we're looking at this, they've got a lot of this is effectively a conglomerate that tries to do too many things all at once. So the focus on the park business is obviously critical. That's where I am. But my focus with this company is one, the streaming, right? Because you've got Disney Plus, which is part of the whole Hulu and ESPN package, and I don't know how you feel about that, but look, that's an oversaturated market. Netflix is the clear market share leader. And if you look at what Disney is doing, they're engaging in price hikes just like everybody else in order to try to squeeze every single dollar possible out of this. The other element is, what are they going to do with ESPN? I think that is the big question moving forward. They probably can and should run this thing out, spin this thing out over the long term, largely because the cost associated with all of these agreements with like the SEC and college football, all the costs of these things are moving higher. And it's going to be very, very difficult for some of these companies moving forward to manage the expectations and build subscriptions at a time that the cost associated with broadcasting just continues to move much, much higher. So I look at this, I think ESPN's the bigger question, that people aren't having a lot of conversations about. We talked about gambling and ESPN, and if they're going to get into that space, Disney doesn't want that. They still want to try to enhance their family image as much as they possibly can. There's too much going on all at once, and it's very, very clear that Iger coming back, they've got a long process ahead of them. It's going to take multiple years for them to streamline and figure out their operations and to bring this back to kind of where it was a couple of years ago.
Mhm.
This is going to be a very, very choppy business to trade. I would focus only on it when it is trading in positive momentum. The ideal way for me to trade Disney, momentum goes positive. You're going to see some capital come into the market. You're going to see a stock like this probably get a little bit of a bump. I don't care if the stock goes up. I would be selling put spreads on this type of name to the downside, down around the $90 to $85 level, only if momentum is positive.
Okay, so Disney only favorable to trade in positive momentum situations. Florida man appalled by the $20 turkey leg that's apparently going down over there. Shaw, we're going to bring you in here, whether it comes to their ESPN arm or their layoffs. Do you find Disney tradable at this time?
No, flat out no. I'm a big fan of Bob Iger's. He's not going to be able to single-handedly turn the company around in short order, in time for a good trade, in time for an investment. So I think anyone looking at Disney is looking to see, as maybe Garrett said, buy, sell put spreads, sell puts to try and buy it lower. Why? Where is it going to go even then? This is a conglomerate, again, as Garrett correctly pointed out. Huge revenues, $84+ billion, profit margin less than 4%, combined profit margin across all the units less than 4%. So the amount of change that they're going to have to render on in terms of job cuts, in terms of operational expense cuts, it's going to have to be tremendous to make an impact on the profit margin. And I don't think the revenues are going to do the job for them, especially if we head into a recession. So there's plenty of other places to park your capital, especially if you want to have long-term dividends. No dividend yield here, zero dividend.
Mhm.
So to me, it's just a non-starter.
Shaw, trimming the fat seems to be news that investors cheer, as we did see Disney stock react favorably to this, and you usually do see that. I mean, there, once in a while we'll get a stock that will sell off after a big axe is dropped. But are you seeing any other stocks or predicting any other companies that will continue with this process of trimming employees? And do you find any trades within them?
I think there are going to be a lot of companies that are going to come to the fore and announce layoffs. I think if we continue to see rates held up at this level, and whether or not they go another 25 basis points higher in the Fed funds, I think is why it's in the short term. In the longer term, what really matters is how long rates stay elevated. If they remain elevated for some time, I'm talking a couple of quarters to another maybe 6 months, a year, then we're going to see a lot more layoffs because the economy is going to continue to slow. I think we will see a hard landing if we don't see some cut in rates, and I don't think we're going to. So as far as layoffs, I think there are more ahead, and the companies that are out there are the ones that obviously, beefed them their rolls up, their employee rolls up in the pandemic, and are now cutting. But again, as Garrett pointed out, and I 100% agree with him on everything he said, well, we're going to start to see that in some mainstream companies, and maybe not so much the service sector companies, but certainly manufacturing companies, and that's going to be beginning of the end. I think we start to see that, and then we see that eventually there's going to be a rate cut. So I think the market's going to have to endure some pain till we get to that point.
All right. Well, we are hating on Disney right now, but it is still highly tradable, whether you hate it or not.